we're at that stage, gold is still going up to new all-time record highs. I mean, it shouldn't be that way. Gold should really only be at all-time record highs immediately after an inflationary spurt, right? Not in the months and years afterwards when, the stocks start going up and other derivatives start going up. So money starts leaving gold, leaving the safe haven, chasing the momentum. And we're going to go much higher once the next inflation round starts. And we could talk about that too. But I'm pretty, just bottom line, I'm pretty surprised we're at all-time highs in this situation right now. I thought we would be lower, and the fact that we're at all-time highs means we have a long way to go when the next inflation round starts.
This week, gold prices surged to around $2,590 per ounce, marking a new all-time high. This significant rise is driven by the weakening U.S. dollar, falling bond yields, and increasing expectations that the Federal Reserve will introduce a substantial interest rate cut in its upcoming meeting. According to current futures data, there's a 59% chance the Federal Reserve will implement a 50 basis point rate cut, as tracked by the CME's FedWatch tool, while a 25 basis point cut has a 41% probability. This anticipated policy shift has been fueling the recent surge in gold prices. The Federal Open Market Committee, FOMC, is expected to announce this cut, with the potential for further reductions over the next 15 months. Meanwhile, the U.S. dollar is facing growing scrutiny as excessive government spending and loose monetary policies continue to erode its purchasing power, raising concerns about broader financial instability. The gold market seems to be repeating past trends, with prices hitting new highs similar to those seen in 2011. Back then, gold reached record levels before entering a prolonged bear market that lasted from 2011 to 2015, during which investors shifted toward riskier assets, leading to a sharp decline in value. A similar pattern occurred in early 2022, though the recent dip in gold prices was less severe, with prices staying above $1,610. Financial analyst Rafi Farber draws comparisons between the current gold market and these past cycles. He acknowledges that while the bear market from 2011 to 2015 was particularly harsh, the current environment is more favorable, with less dramatic declines and stronger market resilience. Rafi predicts that gold will likely continue its upward trend as inflationary pressures grow, potentially reaching new record highs. We will now present clips from Rafi Farber with Liberty and Finance. Before we do, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The dollar's dying, thank God. With all the damage that dollar spenders, the main dollar spenders, of course, the federal government, with all the money that they're spending all over the place destroying things. There's a lot of collateral damage to the death of the dollar, and we're part of it because we spend them and we use them. But, we can adapt. We can adapt, and the U.S. government can't because that's their main resource supply, is the fact that the world accepts U.S. dollars. But as for the gold market itself, it's pretty surprising that gold continues higher here, even though this is going to sound a little bit maybe heterodox or contradictory, but it's how things actually are supposed to work. Even though more money keeps entering the system, and the money supply is still much higher than it would otherwise be had the 2020 and 2021 printing not happened, which means that the stimulus effect should still be here. Even though we're at that stage, gold is still going up to new all-time record highs. I mean, it shouldn't be that way. The gold should really only be at all-time record highs immediately after an inflationary spurt, right? Not in the months and years afterwards when, the stocks start going up and other derivatives start going up. So money starts leaving gold, leaving the safe haven, chasing the momentum. But we're not seeing that now. We're seeing the momentum starting to die off, and gold hitting record highs. I mean, think about what happened in the last bull and then bear market. The bull market lasted until 2011, and there was a bear market in 2015. So you had this QE 1, 2, 3, right? And then gold hit record highs in 2011. And then we had like a 4-year bear market as money started to flow out of gold. There was less of a panic about the dollar, and then they went into these risk assets again. We had a little bit of that into 2022, but what, gold hit a low of like 1610 and then didn't go below that. So we're seeing sort of a repeat of we saw a little bit of a repeat of the 2011 to 2015 bear market, but it really wasn't much. It was nothing compared to what we went through. I don't know if you were actively investing in gold back then in 2011 to 2015, but I was, and I was much younger. I had a lot less capital. I was just starting out, but I was still in an end game mentality. I was very naive, but I didn't know it could last this long. But I remember going through 2015, and like waking up nauseous, and like realizing that my portfolio was like cut in half, or even like 40% of what it once was. And I was trying to convince my wife, like, we were right. I'm right about this. We just have to get through it. And I got through it, thank God. But it was very difficult. This one, it wasn't much. Like, okay, 2022 went down to 1610. Okay, my portfolio is not doing so well, but whatever. It didn't really matter that much. So it's much easier this time. And we're gonna go much higher once the next inflation round starts, and we can talk about that too. But I'm pretty. Just bottom line, I'm pretty surprised we're at all-time highs in this situation right now. I thought we would be lower, and the fact that we're at all-time highs means we have a long way to go when the next inflation round starts.
According to Rafi's analysis, the repo market has become a crucial indicator of potential risks within the banking system and the broader financial landscape. The reverse repo program, a tool designed to manage liquidity, is on course to be fully depleted by the end of October if current trends persist. This depletion could significantly impact banks, especially in maintaining their reserves and liquidity. Daily fluctuations in the reverse repo market reflect the ongoing pressure, with balances now reduced to around $240 billion. Experts predict the depletion could occur within 6 to 8 weeks, potentially extending into November or December, creating a pivotal moment for the Federal Reserve to reassess its policies. As a result, there is growing speculation that the Fed may be compelled to shift from its current policy of quantitative tightening, QT, to quantitative easing, QE. This move would inject additional liquidity into the financial system, potentially stabilizing banks but also creating ripple effects in other markets. One likely consequence of such a shift would be a surge in gold prices, as investors often seek gold as a safe haven during periods of economic uncertainty and major policy changes. Now, let's return to the rest of the interview.
So it's important to understand the train of money here. When the Federal Reserve shrinks its balance sheet, it gathers dollars in from whatever parts of the economy to buy, and then the debt that's on its balance sheet, whatever treasuries it is, gets repaid to the Fed. The Fed doesn't reinvest the dollars. The dollars come from wherever, from whoever owns the other side of the treasuries. Essentially the government, right? They're paying it back, but the government gets the money from taxpayers, right? It's vacuumed up through the federal government to the Fed. The Fed takes it out of existence, and then what happens is the government issues a T-bill, right? A short-term treasury bill for dollars that comes from the reverse repos that are earning 5.3% back at the Fed. So there's like this store of money at the Fed. While the Fed is sucking dollars out of existence from the Treasury to the Fed out of existence, they're putting money from the reverse repos back to the Treasury, right? When the Treasury sells a T-bill, and that money in the Treasury goes and spreads out throughout the world on whatever the government decides to spend money on. So really, it's like money's being vacuumed out of the banking system and then being shoved back into the banking system through the same treasury mechanism to the reverse repos. So then the question, we have this circle going on, this like drain going on, but it keeps being refilled by the reverse repos in the same direction. So the question is, like, what happens when there's no more reverse repos? Where are the other dollars going to come from? Right? They've got to come from something. You can't just like the treasury can't just sell a T-bill and then have dollars come into existence to buy that T-bill, unless the Fed's doing it. But the Fed can't do that directly, and they're not, and they're still still shrinking their balance sheet. QT is still ongoing. It's at a slower pace, but it's still ongoing. So where do those dollars come from? The answer is they got to come from bank reserves. But bank reserves are being used up by what? They're being used up by repos, because you have all these speculators that are using this repurchase cash. That, look, just take a step back. If there's repos going on, right, that banks are trading, if that's happening, that means that a lot of banks are short cash. Otherwise, they wouldn't be borrowing cash overnight, right? Why would you need to do that? You're going to pay, what are their rates? 5.35% for cash that you don't need? Well, either they're borrowing it because somebody else is borrowing it from them for the night to like satisfy some contract that they're short. Maybe it's Treasuries itself, or the bank is short cash and they need to borrow the money. So the current repo volume is like 2.2 trillion a night. It fluctuates wildly between like 2 trillion and 2.4 trillion lately, like $400 billion a night. Then where's this stuff going to come from if there's no more reverse repos? It's going to come from the bank reserves, and there's not enough money there because like 70% of it's being used for repos already. And once you get too high, then there's going to be a repocalypse, meaning the interest rates, the overnight interest rates between banks are going to rise to like 10%, just like they did 5 years ago tomorrow. So this is going to happen when the reverse repos run out, and we're down, I think today, 45 billion. I predicted this. That we're going to be around 240 billion. I think I even used that number on Endgame Investor that I wrote this morning, because I just saw that today was corporate tax day, so all the corporations are sending their tax money into the Treasury, and that money comes from reserves and it goes into the Treasury's account, and then they spend it back in. So we're down about 45 billion. There's 240 billion left, 239 billion. It should take, I don't know, 6 to 8 weeks. The pace could always change. It could be November. It could even be December. I've been wrong about it before. It doesn't really matter when. The trajectory is down. It's going to continue down until the Fed reverses QT to QE again. And that's what's going to skyrocket gold. There's going to be some kind of crisis that's going to trigger it. It's not going to be like, oh, I think we're going to calmly pivot now. There's no calmness. It's always sudden.
The weakening trend of the US dollar is playing a key role in pushing gold prices to new highs. As the dollar's value declines, investors increasingly turn to gold as a safe haven, enhancing its appeal. This inverse relationship suggests that gold is likely to maintain its upward momentum as long as the dollar remains weak and inflationary pressures persist. What do you think will have the biggest impact on gold prices in the coming months? Share your thoughts in the comments below. Don't forget to like this video, subscribe to the channel, and hit the notification bell for more updates. We appreciate your support and look forward to seeing you in the next one. Thanks for watching.